Hello everyone, today we will discuss about rules of debit and credit. As we all know that all the accounts of a business will be divided into several parts. Now all those accounts, if we prepare, then we will be dividing it into two parts. Now this is the format of a T-shaped account. Then this is the T-shaped account, and on left hand side we have debit side, and on the right hand side it is called as credit side. Now according to your book, there are two approaches given. So today we will discuss about these two approaches. The first one is known as American approach or modern approach, and second one is English approach or traditional approach. Now first let us discuss about American or modern approach. Now what this approach says is that all those accounts related with a business, they will be divided or they will be classified into these 5 types of accounts. So for your better remembering, I had made a small shortcut. You just have to remember clear, CLEAR. Now see this clear, all the accounts will be divided into this, will be classified into these 5 types of account. And what are those? Let us see. C stands for capital or owner's equity account. Then L, liabilities account, like we used to see creditors account. All those things are nothing but liabilities account. Then E stands for expenses or losses account. If we have any expenditure or if we have incurred any loss, then all those accounts will come under this expenses account. Then A stands for assets account, and R stands for revenue or income account. For example, like sales, we used to sell every day, so this sales account is nothing but revenue account. Then income, suppose if we have received rent and all those things, rent, commission, rent, commission, and all those things will be known as income account. Now for making a T-shaped account, we know that they have two sides. All the accounts have two sides. Either it is debit side, it is debit and credit side. Now on which side we will make entry, that depends on certain rules that we will learn in this session. Now according to modern approach, the rules for these 5 types of accounts is nothing, means you have to understand what kind of account will come under which category, whether it is capital, whether it is liability, whether it is expense, assets or revenue. After that, now the thing that you have to remember is that expenses and assets, these two account is same, means if expenses increases, then it will be recorded on debit side. If assets increases, then it will be recorded on debit side. And if the amount of expenses or assets decreases, then it will be recorded in the credit side. Now for your better remembrance, I have given you another shortcut, that is AIDS. Now full form of AIDS is asset increase debit side, means if asset is increased, then it will be recorded on debit side, same as expenses also. And the remaining 3 accounts, capital, liabilities and revenue, they are opposite of these two, means if it increases, then it will be recorded on credit side, and if the amount decreases, then it will be recorded on debit side. Now these are the main basic rule of debit and credit, and it will be used in every stages of accounting. So it is highly recommended from my side that you should by heart these rules. Then let us see one example. Through this example, you will be able to understand how to prepare T-shaped account and how the rules are followed in this kind of approach. Now in illustration number 18, they say that open a T-shaped account for furniture. Now furniture, we know that it is an asset account. So asset, we know that if asset increases, it will be recorded on debit side, that is asset increase debit side. This is AIDS. Okay, now we made a T-shaped account for furniture account, debit side and credit side. Now let us see first transaction. Furniture purchased for 20,000. That means the value of furniture has been increased, means after purchasing, the amount of furniture in our business has increased by 20,000. So means asset account is increased, so we will record it in the debit side by writing to cash, means furniture was purchased worth rupees 20,000. Then next transaction, furniture sold costing 5,000, means when we sell furniture, then it means that the amount of furniture in our business has been reduced by 5,000, so means it is decreased, so we will record it in the credit side by writing by cash furniture sold 5,000. Then next transaction is furniture again purchased for 8,000, so it means the value of furniture in our business has been increased by 8,000, so we will write on debit side to cash furniture purchase 8,000. Now after that, transaction number 4, old furniture discarded. Discarded means it was thrown out from the business. That also leads to the decrease in value of furniture, so we will write it in the credit side by writing by furniture discarded rupees 2,500. And the last transaction is value of furniture was reduced by 2,000, means reduced means nothing but it is known as depreciation, because every year we used to deduct some amount of value of our asset, particularly fixed asset, and it is known as nothing but depreciation. So since the value has been decreased by 2,000, so we will write by depreciation rupees 2,000. Now after recording all the transactions on debit and credit side, what we will do is we will find out total of both the sides. Now total of debit side is 20 plus 8,000, that is 28,000, and total of credit side is 9,500. Now see, on debit side we have 28,000 and on credit side we have 9,500, so there is some difference. That difference we will write on credit side because credit side is lesser in comparison with debit side. So in order to match both the sides, first we will find out the difference between the total of both the sides, and we got 18,500. Now this 18,500 is nothing but our balance, so we will write this 18,500 in here, and after adding this 9,500 and 18,500, we got 28,000 on both the sides of this furniture account. So this is how we used to prepare T-shape account, and this rule will be applied while preparing ledger account. So it is better for you to understand the rules, to by heart those rules, and to understand how to balance both sides of an account. So this was your modern approach. Now we will look at second approach, that is English or traditional approach. Now under this traditional approach, all the accounts are divided into two parts. First is personal, second is impersonal. Now under personal account, it is again further subdivided into three parts. Now first is natural account. Natural account is nothing but it will be a normal human being like me, you, and any other account. Like for example, if a business transaction involves Ram, whether that Ram may be our credit that Ram person, he is a natural human being like you and me, so his account will be nothing but personal account and natural account as well. Then next is artificial account. Artificial account is nothing but an institution, like a company created by some natural human beings. Like we can take example of ICICI Bank, then Reliance company. All those things are nothing but artificial personal account. Then last is representative account. This we will discuss a little bit later, but first let us see impersonal account. Now impersonal account are again divided into two parts. First is real, then next is nominal. Now first let us talk about real account. Now real account, it includes all the assets, like earlier in previous illustration we saw furniture account. So furniture is also a kind of asset. Similar, machine, land, etc., and there will be lots of assets account. All those accounts are known as real account, except for two, that is bank. Bank is an artificial account. So bank is an artificial institution created by human beings. So bank account is artificial personal account. Then another one is debtors. Now debtors debtors are natural human beings, so debtors account is also personal account, and it is known as natural account. Now you have to remember is that in real account all assets are considered as real accounts except for bank and debtors, because these two are personal account. Then next is nominal account. Now under nominal account all the expenses and revenues are known as nominal account, like sales account, rent account, salary, commission, etc. There are other expenses and revenues, all those things will be known as nominal account. But if sometimes suppose this salary account is also a nominal account, but suppose if there is any prefix or suffix added to nominal account, like outstanding salary, rent due, commission received in advance, or accrued interest, then those nominal account will become personal account. Okay, so you have to remember only this thing is that under traditional approach accounts are divided into three parts. First is personal. It includes natural, human being, artificial, institution created by person. Then representative account, which is nothing but nominal account with prefix or suffix. Then under real account all the assets are included except for bank and debtors. And last is nominal account, all the expenses and revenues are known as nominal accounts. Now under traditional approach also there are some rules. Now these rules are nothing but, for personal account rule is debit the receiver and credit the giver. On debit side we will write receiver's name, and on the credit side we will note down giver's account. Then for real account rule is debit what comes in, means if you have purchased any asset, it is coming inside your business, at that time you will debit that account. And suppose while selling asset it is going out from your business, so that time you will write on the credit side, because the rule is credit what goes out. Then for nominal, means all the expenses and revenues, you have to write debit all the expenses and losses, and you have to credit all your incomes and gains. Now these were rules regarding traditional approach, but basically for doing T-shaped account we go with modern approach or American approach, and for journal entries we use this traditional approach. Now today we will discuss only about these rules of debit and credit, and in our next session we will be solving some questions related with these two types of approaches. Hope you understood these rules and rules of debit and credit, and if there is any confusion then you can contact me, but it will be very good for you to understand this rule and to by heart these rules, because until unless you are not clear with these rules you won't be able to prepare your financial accounts. Okay, so for this session we will wind up here. Thank you.